Let's bring in our guest now, Julian Callow, chief economist, Barclays Capital. Julian Callow, good to have you with us. I guess the first question is, how come you're not in Davos? Everyone seems to be in Davos this week.
Well, we have people from Barclays in Davos. You can rest assured. So we like to be in several places at once.
Now, I was listening to Tom Keene's interview with Nouriel Roubini and Joseph Stiglitz, and I felt like I almost wanted to slip my wrists after this, that the world is so gloomy, everything's coming to an end. Are things really this bad?
It's not really what I see in the data. I see actually forecasts of US GDP getting, if anything, revised up a little bit, the consumer holding in there. Certainly when I look at Europe, I see the German economy that is doing extraordinarily well. I mean, one very interesting statistic, the hiring intentions at the moment by German companies are the highest since 1990. Now, I don't know if you think back to 1990.
Goes back to the reunification program.
The West German economy was very strong in the late 80s, and then they had reunification, and that turbocharged it. We have the highest level of German employment expectations among German industry since then. So the German labour market is improving very dramatically, but you're seeing some improvement coming through as well in the case of France, and we're seeing some very good confidence levels for the euro area as a whole if we look at various levels like PMI data, European Commission data, for example. So, you know, things aren't really as bad as they might perhaps appear here.
So why do you think that we have this drumbeat of gloomy analysis? Because indeed, yes, there are problems in Ireland, in Portugal, in Spain, in Greece, but that is not the majority of the European Eurozone.
I don't want to pretend it's going to be that easy going further forward, right? There are a number of issues. One is the emerging economies increasingly face some very real inflation risks. And by and large, my assessment would be that the monetary policy is way too easy in many emerging economies. The central banks in many emerging economies are used to really tracking the Fed. But this time, the Fed is going to be one of the last central banks, maybe except the BOJ, to be raising rates. So, you know, they're having to make their own way, but it's very incremental. There are some other risks as well. You know, on the debt side, we're dealing with high levels of household debt in many countries, and the government side. So it's not going to be straightforward. But if we actually look at what businesses are saying right now at the global level, they are certainly looking forward, I think, to the year ahead. And we should be seeing some traction in the labour market.
All right. My guest, Julian Callow, he is chief European economist for Barclays Capital. Julian, we were talking about some of the challenges that are facing countries in Europe, particularly the ones that maybe have benefited from many of the easy money policies.
Exactly.
So how long does this period last? Do you have any kind of experience with whether this is a 6-month period of austerity, or does this go much further?
Oh, it's going to be much further. I mean, if you look at where the deficit positions of different countries were last year, you're talking about Spain with a general government deficit as around 9% of GDP. Portugal, they did a special one-off measure, so underlying it was probably around 8.5% of GDP. Ireland around getting close to 12% of GDP. In fact, the UK also around 11% of GDP, and Greece at 9%. So you've still got a very, very long way to go. And part of the problem is that these countries have lost a lot of competitiveness. In the case of Ireland and in the case of Spain and potentially Portugal, there's certainly further downwards potential for residential and commercial real estate prices. That's another source of drag. So it's going to be a multi-year process. You know, we don't really have that many historic episodes where countries have endeavoured to do what these countries are trying to do in terms of the degree of the fiscal adjustment. I mean, we're talking about fiscal adjustment that's over a period of 3 years running at between 6 and 9% of GDP. That is truly extraordinary. And I think the environment is going to be uncertain for these particular countries. You had the UK GDP numbers, which, of course, disappointed recently. I think the problem is we don't really know how well the private sector is going to react to the fiscal tightening. So, you know, economists are always going to hedge their bets and say, look, it's uncertain out there. But
well, that's why you've got two hands, on the one hand and on the other hand, right?
Thank you for that, yeah. So I think really, I'd say it is particularly uncertain at the moment with respect to how the fiscal policy will impact. Will the private sector actually take confidence from that the government is starting to get a bit smaller here in terms of its borrowing?
Let me break in, because I just want to find out, do you feel that the countries like Ireland, like Spain, like do they have anything to show for the past profligate behavior?
Ireland has a very strong export sector. Ireland is very biased towards high-tech industries. In fact, a lot of American companies, of course, invested in Ireland. But Ireland has also the highest level of debts to GDP, including the United States. It's got, if you're adding government and household and non-financial corporate, it's running at 390% of GDP. The other countries, they've got a developed infrastructure and construction, but I have to say, not a lot else. Yeah.
All right. Well, we're going to have to leave it there. I want to thank you, Julian Callow of Barclays Capital.